A warm welcome to the Crystal Cast. I'm delighted to be joined by three industry heavyweights who are going to provide us with a good barometer on the specialist lending market, both past and in the future. I guess you guys don't need an introduction, but here goes one anyway. I'm delighted to be joined by Adrian Moloney, Group Sales Director of OneSavings Bank, Marc Goldberg, CEO of Sales and Distribution at Together Money, and Josh Elash, Co-Founding Director of MT Finance. So reflecting back on 2023, Adrian, what factor has had the most significant impact on our sector during this year gone?
That is a good question. So I think if I go back to the start of 23 and look at Q1, it seemed everything was going quite normal. It started to gather pace. Rates were probably quite competitive, and we had a sort of a functional market. We probably got to the end of April and through the summer, and we saw swap rates go up, fixed rates go up in the long-term market and in buy-to-let, and probably some constraints in residential around affordability, and probably in buy-to-let around ICR coverage. Hopefully, he said, hopefully, we've now seen the peak of those rates. We're now starting to see a more competitive landscape and environment out there in terms of the way rates are and in terms of the way lenders are competing for business. If I take a sort of step back and go, what's actually gone well? I think specialist lending has gone well. I think particularly in terms of if you look at the commercial, the bridging market, portfolio landlords, and for brokers that play in that market, there's still been opportunity. Certainly, I mean, if you look at our trading results out Q3, 1.3 billion of completions in that period, and 7% net loan book growth in the period to the end of September. That's a fairly successful year, in my opinion, in what's been a market which has come with its challenges. But the main bits for me around the challenges were around, I guess, affordability and probably ICR coverage in buy-to-let. But that's been weathered, I think, by those brokers that deal with specialist lenders and I guess more complex clients and portfolio landlords.
Yeah, and I think that's it's a massive point. And unfortunately, within your brand, you've got many different channels. So buy-to-let, one dips, the other peaks. So negating all that, I think, has also been probably part of the challenge. You're probably getting more business from areas you weren't in years prior, and vice versa. With that in mind, Josh, in the bridging game, and specifically for your business, what success stories or specific challenges has your business had to overcome in adapting to the market changes of 2023?
Well, I think Adrian kind of already hit the nail on the proverbial head. I think the biggest single challenge wasn't necessarily the rate rises, but the rate at which the rates rose at a really unprecedented level. I think everyone was very consciously aware that inflation was an issue. But I don't think anyone, certainly I hadn't seen in my professional lifetime, the rate go from where it was to where it ended up as quickly as it did. And I think every financial institution in the UK really had to grapple with that and to come to terms with that and to be proactive. So when we talk about the successes that we've had as an institution, we've gone back to looking at how we can apply innovation at the product level, how we can continue to be relevant. So you've referenced our bridging side of the business, but we launched a buy-to-let business in July of last year, which was probably either the best or the worst timing in history for launching into a buy-to-let business, depending on your perspective. But we did that at a time when swap rates started to kind of blow out. So we had to get back and look at what can we do to make sure that our products are viable? How do we make sure that our products work for the buy-to-let investor community? So looking at restructuring things, so applying more fees at the front end so that we could then apply a lower run rate through term, which kind of made ICRs work a little bit better. So I think other people have also done that in the space. Traditionally you saw 1 or 2% in fees, and now you're seeing 3s and 5s and 7s, and in some instances 9s. So we've employed some of that innovation to make our products more realistic and more viable for the actual consumer market. On the bridging finance side of the business, it was a very, very tricky period. There's always a bite point where bridging finance ceases to be an attractive proposition. If it's just too expensive, then it just doesn't work. It's not fit for purpose. But I think, as Adrian's rightly said, thankfully it appears as though in the general consensus is that we've got to that top end of the interest rate environment, and we seem to have now settled as a market it's kind of found its feet. Pricing seems to have settled across the majority of the space. And we've also seen record levels of business. We're up 30% on our bridging finance side of the business versus where we were last year. So whilst it's been a challenging year, whilst we've all had to adapt to this new higher interest rate environment, the rate at which interest rates increased, as an institution, I think we've done that very well by being innovative and looking at our products and making sure that they were fit for purpose.
And Marc, obviously, along similar veins with yourselves, a fast-growing business, established but fast-growing, particularly in the last 4 or 5 years. What sort of challenges have you had to face?
Well, we talk about rising interest rates. I think it's not been as difficult on the front book. It's been more difficult on the back book. There was a period when interest rates first started going up. It took us 3 months. We hadn't increased interest rates for 10 years. We had to dust off the manual of the book to say, how do we do this? What impact can it have on customers? How do you do the direct debits? So that in itself was more about supporting your back book, your customers. A lot of people, fortunately unfortunately, in our retail business, we have a lot of people on fixed rates, so I've been less impacted. On our buy-to-let book, it was more of people on variable rates. Cost of living was also sentiment to lend, as and when Liz Truss did what she did in 2022. The impact that had on confidence in the marketplace, income and affordability and mortgage approvals, and just lenders changing their sentiment and attitude. I think a lot of people that took out bridging loans expected to get a remortgage. Then when they did the ICR calculations of the income and affordability, I think that was a lot of people sort of fell out of the lending criteria. And I think consumer and business confidence during the last 12 months has been a bit of a roller coaster. I think, as Adrian quite rightly said, I think we're beginning to see, the success factors is Bank of England stabilising rates. Let's face it, properties are selling, both residential and commercial, which is a positive. I look at the auction stats, albeit sometimes properties maybe have to go in more than once. You've got to make sure that obviously it's fairly priced. And, one of the things I read a lot of in the press, which probably frustrates me, is this is not a property crash. This is a property correction. Interest rates were extremely low. Everyone saw property as the key to invest in. Lots of people did it. Lots of novice buy-to-let landlords. And as and when interest rates have gone up, they've really struggled if you were not on a fixed rate. But I think the opportunities for 2024, there's a shortage of homes, there's a shortage of mortgage approvals, which is only increasing the rental market. We've seen anywhere between 15 and 30% increase in actual rentals, in the actual rent you're getting per month. So I think, and as Josh said, the actual support for bridging is massive. Unfortunately, the banks, and I'm not including Adrian and any of your companies in here, but the challenger banks, I think, are finding it difficult to take pace with what's happening. It's taking a lot longer, certainly a lot more on underwriting. It's taking more time, which I think is fueling the bridging market. And as Josh said, there is a point which bridging can become not the right option. But I think any of the traditional bridging or the serious bridging lenders that are out there see where the opportunities are and don't see this as a get rich quick sort of type of business. They want repeat customers to come back time and time again. And there is a purpose that if you think somebody says it's going to take 4 weeks to complete a remortgage, it's taking 8, and commercial mortgages it's taking up to 3 months. So for the likes of the people in the bridging market, I think the opportunities in 2024 seem really positive, but it's going to be a tough year next year.
I think we're going to see a period of consolidation in the bridging finance market. All the points that Marc just correctly alluded to, which is, largely going to that back book and the asset management, the NIM squeeze that all lenders have encountered over the course of the last year. We're seeing kind of like liquidity being pulled back out of the market. A lot of the big capital markets players that have put a lot of liquidity into this market over the last decade have already come back out. So when we talk about, there being strong demand, and actually pretty resilient property market, but then you factor into that equation, probably in 2024, a decrease in the number of players operating in the bridging finance space. There's a tremendous opportunity for the institutional well-established bridging finance lenders who have well-equipped asset management teams who are capable of managing out their back books to go forward and really capitalize on the momentum.
And I think I'd agree on that on also in the buy-to-let market, which is Adrian is really big in, commercial term loans as well. Look, if you're a business that's putting the customers at the heart of everything that you do, making sure that your products are fit for purpose, making sure that obviously everyone knows why we're here is to get a rate of return or return on equity. So I think strong players who basically are moving with the market and understand it, there is a great opportunity. And it's the same in the brokers and packager market. At the end, if you're good at what you do and you look after your customers, look, I'm not saying it's going to be easy, but I do think there's going to be a lot of opportunities out there, and a lot of the players that are taking this really seriously and looking at new opportunities all the time and moving with the market. I think that 2024 has got some really good positive green shoots to look at.
So from the broker point of view, then Marc, on that one, so what you're saying is basically brokers should look at every opportunity,
Definitely,
and its merits, and try their utmost to convert it.
I think there's a lot of brokers traditional. I was speaking to Tanya about this, who obviously runs our sales and distribution for packages and brokers. What she was saying is more and more brokers traditionally have stayed into a retail sort of background or a commercial. I think you've got to look at every opportunity, service the customer, and there isn't that much difference if it's secured on property. The way of doing it and getting that expertise and putting the customer at the forefront of everything that you do. Looking at ancillary products, I know insurance is a big thing that more and more people are looking into. But if you focus on the customer, what is their need, which lenders are out there that you trust that can deliver the right outcomes for the customers and the packager and broker, at the end of the day, there is a lot of opportunities out there. It's just getting more difficult now with valuers downvaluing properties because they're nervous. So we have a lot of things to contain, but I think the opportunities are definitely there.
To probably echo some of the points that the guys have said, is actually for intermediaries, this is a good market because people need advice more than ever, access to different products. To the point that both Marc and Josh have said, lending can be more difficult at times. I think in the mainstream market, you're seeing a lot of PTs. People staying with their existing lenders like ourselves, being very proactive in trying to retain that business. But actually, on the more complex side, if you don't have expertise in it, there's partnerships just like Crystal that you can go to that access different products that perhaps aren't there in the general market. So I think we were both at an event last week, Joe, and speaking to a lot of brokers. They actually say over the last few weeks, sentiment with clients has changed. People have been a lot more proactive. They're making more decisions. Rates being offered by lenders compete with, I'll just give you an example, PT rates. So actually, are they going to refinance? They can fit with that. So I see 2024 as a good year for brokers because I think the pricing and lenders are being more competitive than they were in the middle of this year. To Josh and Marc's point, the stronger lenders will do well in this market. They are the ones that focus on the customer needs, have products that support that. So if I'm a broker sitting here going into Christmas and into 2024, I think there's a lot more reasons to be cheerful than perhaps there was halfway through this year.
Yeah, and I'll probably add a little bit to that as well, because we sort of believe that the refer and earn model is one that will really catch on next year. Brokers don't have to be afraid of taking on the risk of advice themselves within a specialist game. I think there's quite a few networks out there that actually discourage their brokers from dealing in the specialist market because they're scared about the risks involved and the recourse further down the line. I think where distributors come in and can offer value to the brokers in 2024 is the refer and earn model, where we work in partnership, we'll carry the advice and all the regulatory obligations that go with that, and the customer gets a great outcome, which means that when he comes back round to do the retail transaction further down the line, you should have a better retention rate, as a result. So I definitely think that there's more than one way to skin a cat, and 2024 should be one where brokers walking around with their eyes wide open. For me. What about in terms of risks for next year? What are you guys seeing or hearing up the track? Again, I'll start with you, Adrian.
Again, if you're in retail, is it PTs again? Is it people retaining their lenders retaining their business and staying with them as opposed to a buoyant remortgage market? purchases this year, the UK finance figures were out today, are obviously down compared with previous years. Will they pick up? Because I do think you need a buoyant purchase market, and that's first. I like first-time buyers coming back into the market to have an overall buoyant mortgage market. I mean, the big bit we've got next year potentially is a general election, and what the outcome of that is could sway the way in which the property market goes in 2024. Look, the other bit I think there is at the moment, and I'll say to a lot of people, expect the unexpected, because none of us expected the results of last October. None of us in probably March expected rates to go up at the rate they did over the summer. So the bit to anyone is, for me, what I've learned over the last 12 months is expect the unexpected and be prepared to deal with it.
Yeah, good points there. Josh, anything else to add on that one?
Well, yeah, I think, look, at a macro level, there's so much volatility that we have to look at the potential impact that this may very well have over the course of the next year. I actually think, in our house view, is that 2024 is going to be a flatter year. It's going to be more stable, certainly more so than 2023 was. But I think, in touching back on the point that Marc made, I think we've already begun to see a correction in the housing market. And I think that drives opportunity. Certainly in the investment space, we're already seeing, and we're expecting to see in 2024, more and more of that to garner pace. 2023, even at the tail end of 2022, there was just so little yield in real estate investment that we began to see kind of that level of activity tail off a little bit. So as we go into 2024, as there's this correction in the property market, we expect to see more and more money coming back into the space, more and more investment. And then it follows on from the point that you made, Joe, which is, okay, all of that is happening on a very opportunistic basis, but it's also happening at a time when the lender landscape is changing. The lender landscape has shifted. Products are changing faster on the buy-to-let side than they had ever done in the last decade. Pricing is pulled, pricing moves. On the bridging finance side of the market, lenders are disappearing. Lenders are underfunded or aren't capable of performing. So the need for specialist advice in the year ahead has never been greater. I think that if I'm a broker out there, you make that reference to refer and earn. You kick it up. You work with people who know exactly what they're doing, people who can navigate that landscape effectively. And I think those two things, this real opportunity for increased purchases, more speculative investment, coupled with a greater need for specialist advice, make 2024 a very interesting proposition.
I think as well, Josh, you don't always have to be the cheapest lender to drive that business. You've talked there about people disappearing. A lot of it comes down to reputation and getting the deal done, and that's what we find with our brands. We don't compete with the very keenest of the high street prices, but we have clients come back to us time and time again because of the reliability of getting the deal done and knowing the client inside and out. And I think that's going to be important in 24. Lenders being reliable and sticking to their decisions.
Yeah, I think that's always been the case, but never more so, certainly in uncertain times.
I think you're right though, Adrian. I think Help to Buy, first-time buyers stimulate the market, and we probably need some help and support for them. There is a housing shortage. There's no two ways about it. House builders are building less. There was already a shortage of houses before we got to where we are at the moment. But I think the amateur buy-to-let landlords, those days are gone. But I think, certainly from what I'm seeing, the more experienced buy-to-let landlords are seeing the opportunities. They're buying properties at the price they should have been buying at 2 years ago, where they can make a yield and make a return. For me, I said it this year, but I think next year, second mortgages, people staying in the houses, they're on a fixed rate, they want to do home improvements, they want to do debt consolidation. I see that being a real growth market. We haven't seen it this year, but I certainly think next year. I think, and one of the things I was thinking about, I just made some notes, MT and OneSavings Bank do take very much a common sense lending approach, working with brokers and customers. And I think that some of the challenger banks, and definitely the high street banks, really they're moving away from what the customers are and what is actually happening in the marketplace. And that opens up a lot of opportunities. There is no shortage of liquidity. Someone asked me the other day about what's the difference between now and 2009. There was no liquidity. So there's lots of liquidity there. People want to put it into the right place. For me, one of the biggest probably risks that we have, and I don't know whether Adrian and Josh are the same, but our back book and our existing customers we have to support them. That's really important because there are a lot of people who are either going past term on a bridging loan and find it difficult for the exit. We're very fortunate, as is Josh and Adrian, of having other products to be able to offer these customers if the exit changes or they're not able to get the exit that they wanted. So that's a good thing. And then obviously as they do coming off fixed rates, whether people are prepared enough to say, well, hang on a minute, I'm coming off a 3.59 and it's now 7 or 8 or 6, whatever the rate may be. I don't know who could have planned for rates to be where they were. So we've got to try and support the back book and existing customers and making sure the products that we're putting out there now, really, you don't want to add any more fuel to the fire. So it's about understanding where the opportunities lie in the market. And I think, one of the things that we certainly do is I think for me, where the opportunities are is identify the gaps and opportunities that potentially some of the high street challenger banks aren't serving, because I think the specialist market is only increasing month upon month.
Yeah, totally agree. So moving on to technology and innovation. So Marc, with yourselves, how is technology influencing? How do you feel technology is influencing the mortgage industry in the UK?
Yeah,
and specifically within your business, are there any examples of how innovation and technologies helps you kick on?
Well, all I can say to you is I think probably out of the 3 lenders that are on this today, we're probably behind where we'd want to be on technology, if I'm perfectly honest with you. We're investing between 35 and 55 million pound over the next 18 months to 24 months. Why would why use a human to do what a computer can do? But we take away what I believe is, we call it the special sauce, but that human intervention when it's required. But I think, technology is good, but listen, there's nothing about knowledge and experience and understanding what your customers' needs are, listening to your business partners, listening to what your colleagues are saying and be able to react to the market. So for us, technology I see is definitely for the future, but certainly the short to medium term, it is utilizing the knowledge and experience of our colleagues and our business partners to help support our customers in getting the right outcomes. So, but I'm probably behind the curve on tech, but it's definitely something that's been a key part to the future growth of Together in the future.
And within OSB, obviously there's been quite a few changes on the tech platform side as well. You're actually able to provide PTs for the first time.
Yep. All 3 brands.
Do you want to elaborate a bit more?
Yeah. I think Marc has just to be fair, has a really good point. Technology is often supported by good human interaction, and that's what makes specialist lending, I guess, specialist. So we offer PTs across all 3 brands. We run our 3 lending brands on 3 different platforms. We've signed a partnership. It's in the public domain with Encino, to build us a new lending platform going forward to support those brands, which I think is really good news. They're being built with the broker and the customer at the heart of it. It will automate some of the stuff that we can't automate at the moment and take some of the heavy lifting out of it. But rest assured, there will still be a human approach to underwriting added into that. And keeping those lender specialists. I think all lenders are slightly behind the curve in terms of technology. It's not just you, Marc. It takes a lot of investment, it takes a lot of time. And normally, by the time you get there, you're catching up anyway. So I don't think we'll be the only lender upgrading our platforms this year. But I think we're making a sizable step forward on the upfront journey, as well as supporting us. I think what's been really, really good for us in the last 6 to 12 months, which is retaining our back book and working with customers to retain that. We're actually proactive. We go out to brokers, tell them what they've got coming up, and we help them through that process, which I think in 23, a year of product transfers has put us in a really good shape.
You know, and it is very much as you said, you want to be at the forefront of technology. It's moving so fast, but I definitely think you've got to have human beings running alongside that to make those necessary decisions where, you know, you don't want to be an automatic no. You know, you've got to be flexible. You've got to think about where you want, what you want to do on your product transfers and everything else. Again, it's something that we're very proactive with. You know, we want to help and support our customers when they're coming off fixed rates 12 months before now, having the conversation. So, you know, they're in that mindset of thinking about what's available and then working with our business partners to try and help and support the customer.
So Joshy, then, so you obviously just launched into the, or recently launched into the buy-to-let space. Talk to us about your experience with tech.
Look, whether it's in the buy-to-let or the bridging finance space, we have one simple objective when it comes to technology, which is to automate as many processes as possible, to drive as much efficiency as possible, to increase and improve the end experience for the consumer, whether that's the broker on the origination side of the business, whether that's consumer on the asset management side of the business. You know, technology has to be a very specific focus means to an end. So the buy-to-let platform, we invested a fair amount of money getting that up and running. The bridging finance platform, we've been investing in that for years and years. And the thing about technology is that it's not just a one-off. You don't just drop 30 or 40 or 50 million pounds and then, hey, it's perfect and it's a go. It's just an ongoing commitment in perpetuity. There's always a cost. There's always a maintenance. There's always investments. There's always improvements. Technology moves faster than the speed of light these days. So what we try and do is get that delicate balance where we don't fall down the rabbit hole, but we do look at, you know, how we can improve ourselves as a business, what we can do. We have different operating platforms, and we've learned and we've developed ways of making sure that they effectively interface with one another. But then, you know what, the great thing is both of these gentlemen have already stated, the key thing is just looking at, you know, outside of that automated box, you know, where's human input really, really necessary? And kind of one of the hidden benefits of the buy-to-let market having been as repressed as it was when we launched into it is it allowed us to bed in our technology and our systems, but it also allowed our teams to take an incredibly hands-on approach to every application, to every single case. So kind of resonating with what Marc's saying there about that human element, that human touch. You know, when we've looked at technology and how we can implement it in the business, I think the one area that you just can't really touch, at least not until AI gets to that point, is the underwriting part. So, you know, we've automated offer letters, we've automated offers in principle and indicative terms and statements of account and all of that wonderful stuff. But when it comes to that underwrite, that's where we're just keeping it very, very manual, very focused, you know, old school, because there can be no instance where the computer says no.
You know, Joe, on Friday evening last week, a customer rang me at 6:30 to say he's bought something he's got to complete on Monday. This was 6:30 Friday night. On Monday morning, we were already on with it, got the solicitors instructed, and at 3 o'clock, we completed the deal from start to finish from 6:30 on Friday night. There's no computer that could help you do that. And I think in bridging, it is about that personal touch, being able to make, as Josh said, being able to make those key lending decisions. I think in buy-to-let and mortgages, you can automate a lot of that process. But I think the bridging market is more about knowledge, experience, delivery. You know, making sure that the customer gets the right outcome, but also the business partner, the broker, has a part to play in that, in giving you the right information, supporting, you know, giving the client the confidence that you can deliver. And that gets you the repeat business where they come back to you time and time again. And that's critical to all four of the businesses that we're talking about.
Marc, I thought you were in Lapland. Was that customer Father Christmas or?
That customer rang me in Lapland on Friday night, and guess what? We were still open for business. We still delivered. At the end, we got some fantastic people here at the office. But, you know, that's the unique thing about why, you know, Adrian, you and Crystal and you know, the people who are serious about what they do, we find solutions, not problems.
Yeah, totally agree. So finally, you know, focusing on sort of customer-centric strategies for next year, or any initiatives your organisations plan to implement for 2024. Do you want to have a little talk and focus on those for a couple of minutes? We'll start with AIDS. The plans for 24.
I'd like to have a year of stability to have plans for 24 rather than some of the challenges we've probably had over the last 18 months. But life wouldn't be so fun without challenges. Look, I think for us it's kind of more of the same, but doing what we do well at the moment, that yard or two better, and always trying to search for that improvement. As I said, in a year of PTs this year, we launched a proactive PT approach. I think that was really, really important for our bigger buy-to-let customers. We have the high net worth team that work with brokers on that. We've got a really strong dual branded sales team in that do Precise and Kent, and that supports brokers so that they're putting cases into the right brand first time. And Simon's obviously built a big telephony team to support that. So, I sit there in 24 thinking, continue to have good value products out there with good criteria that supports the market, but making sure that we're front and center of the broker's mind when it comes to specialist lending. If we can do that, we'll maintain what we've done and built so far.
My aim for the last probably 2 years is to be the best service provider. I was looking, our purpose is to help realize people's property ambitions by making finance work. The vision is to be the most valued, not valuable lending company in the UK. The beliefs is respect for people, doing the right thing and being accountable. And, at the start of this year, we said we wanted to be award winning, and, the CCA accreditation and Investors in People Top Employer Award for our category. You know what? That makes me proud. At the end of the day, for me, I want to just continue making sure that the 4 key stakeholders, which is business partners, which is people like you, Joe, the customer at the forefront of everything we do, respect for our colleagues for the fantastic job that we do, and then together and the investors in our business. So that's got to continue the focus. I think technology over the next 18 months will help us probably deliver a better customer outcome in a more timely fashion. But I tell you what, the people that we have and the business partners that we've got, I think make it very, very special. We're going to continue that great work during 2024.
Amazing. Joshua?
Well, I think Marc, as the Business Money Facts Awards winner for best service for 7 consecutive years, I couldn't agree with you more on your first point. Very specifically, we're focused on continuing to grow. We're looking at diversifying further as an institution. The idea is to, systematically become a one-stop shop for both the consumer, but also the introducer, the package, of the broker community. At a granular level, we're going to be looking at how we improve our existing product proposition on the bridging finance side of the business. In January, we're going to be rolling AVMs out for the first time in our history, which is a great evolutionary step for us. We're looking forward to being able to offer that additional piece to exclusively through agreed partners. And then just more broadly, we're just going to be very, very focused on how we can continue to take advantage of the opportunities that are presenting themselves in the market. We're actually really, really bullish on the next 2, 3, 4, 5 years. So without kind of giving away the secret sauce, just watch this space.
Amazing. Thank you. And again, as 3 significant partners with the Crystal brand, we really appreciate the service and innovation all 3 of your brands continue to produce. We align ourselves with the leaders and the customer service champions, and the 3 of you on here today because you absolutely exemplify that. So big thank you from us and the brokers and the customers that we all work with. That's a wrap. I'd just like to thank you all for your time. I think anyone who's watching this after it's gone out, I'd implore you to look at all 3 brands' websites and criterias. They're great brands. They understand customers' needs. They try and find solutions, as has been talked about today. And if you don't have a direct relationship with those guys, go via your distributor of choice. These guys, they deserve all the adulations they get and all the adulations they should get for the next 2 years as well. So just thanks very much for your time today, gents, and enjoy the week ahead.
Thank you, Joe.